Over in the U.S., the government's intervention in the Treasury market is rippling through stocks, bonds, and the broader financial markets. Our Yun-kyung explains.
Global financial markets are facing renewed turbulence as U.S. Treasury Secretary Scott Bessent's aggressive market intervention is coming up against stubborn economic realities. Following the Treasury's announcement to double long-term bond buybacks to $4 billion per operation, yields that had been soaring as well as the dollar have temporarily cooled. However, long-term yields quickly resumed their upward trajectory. Experts point out that a $4 billion cap is not an ultimate solution, as national debt has surpassed $40 trillion for the first time. Secretary Bessent stated that the figure holds no special magic and that the U.S. can grow its way out of the debt mountain. Despite such optimism, structural pressures continue to push borrowing costs higher. Analysts note that corporate bond issuance by big tech giants fueling the AI boom is driving up real interest rates. This strategy has also sparked fears of fiscal dominance, raising concerns that political pressure to lower interest rates could undermine the Federal Reserve's independence. On Thursday, St. Louis Fed President Alberto Musalem firmly distanced the central bank from the Treasury's actions, emphasizing that monetary policy is set independently, entirely focused on inflation and the labor market. Meanwhile, ripple effects quickly hit Asian markets. On Friday morning, South Korea's benchmark KOSPI opened sharply lower, dragged down by overnight losses on Wall Street. U.S. stocks tumbled on Thursday due to a combination of climbing Treasury yields and weak retail earnings from Walmart. Looking ahead, Secretary Bessent hinted that Treasury buybacks could exceed $4 billion and unveil further fiscal consolidation measures early next week, arguing that current yields fail to reflect true economic fundamentals. Yun-kyung, 아리랑뉴스